Okay.
That page.
Do you want me to go ahead and let people in from the waiting room, or you want me to still let them sit?
Yeah. And would you? Oh. Yes, go ahead.
Okay. They are all joining now.
Would you also alert the staff via text message if you don't mind?
As the in-house millennial, I'll make sure and get the word out.
You know? Got to have one on staff, right? Hi, everybody. Thanks for being here. We'll get started in just a minute. Well, a few minutes. If anybody has any questions prior to getting started, we could take a few minutes to answer any questions you might have. Maybe not about this topic, just because we'll get to that. But if you have any other questions, burning questions about getting reopened or anything else, let me know. Nothing burning. People are having a hard time connecting to audio. I wonder if it's internet troubles. There we go.
I don't know about you guys, but I'm waiting for the next color after turquoise.
I'm really hoping it's rose gold.
What's the next super secret probation item we've got here? So.
It's true. Well, you know, not the governor's office, but the Economic Recovery Council asked me, you know, what should the next stage be? And I'm like, open, you know, just no restrictions. Thank you very much.
Kind of like we thought after green.
Right. Yes. And the thing is that they're talking about changing the restrictions within the turquoise or within the green or within the yellow. And it's like, don't do that. Just come up with another one, because we've already gotten used to what's there. And if you change the restrictions in the rest of it, it's just going to drive everybody nuts. So, ugh.
Roman's question was a good one. Of course, I'm waiting for a good answer to that.
Which one?
How do you hire employees when it's better to stay at home?
That is going to be the bane of our existence for this entire year. And I have some thoughts about using some of the money that comes from the ERTC as hiring bonus money.
Yeah, you could do that.
Yeah. And I think that's, you know, depending on how much you get, I think that's a good use of that money. Because it's going to be hard to get people back to work. You know, in the middle of all this, I had the thought that we would lose folks to other industries, because I was having other industries reach out to me and say, you guys don't have work, but we do, you know, give me a list of all of your members and I'll go and solicit their employees. I'm like, no, I'm not going to do that. I'm not going to allow you to solicit their employees. We need them. And, you know, and especially when we get back, we're going to need them badly. And so I think that is what's happened. Some folks have taken state jobs as well that are available, like they're available because of COVID, that won't be there forever. So.
Yeah, I had a Lyft or Uber driver, I forget which, to take me from the Ford dealership over here when my car was being worked on. asked him what he did normally. He said he was a chef for a restaurant. I won't say which one, and he was doing that while the shutdown was in place.
Yeah, the problem is that people are going to get used to other jobs. They're going to, see advantages in other industries, and we got to make it fun to come back.
Yep.
Well, and then somebody else mentioned today that very hard for restaurants to bring people back, not only to rehire them, but for people to feel comfortable that they're going to keep that job.
Yes.
Right?
Yeah.
And that's not happening in other industries as much.
Not when you can change every 2 weeks based on the general population.
Mm-hmm. Got 1 more minute, folks, and we'll get started. We're also streaming live on Facebook. So if you lose us here, you can go over to Facebook and watch us there.
I remember one of the university basketball coaches said one time, somebody asked him how he liked his job, and he said, "Oh, it's great if you like having your job put in the hands of a bunch of 19-year-olds every evening." So, same thing. You don't know when your job's going to be there. If it's every 2 weeks, they're resetting.
Yeah, and I've been trying to convince the governor's office that they really should be letting us know where we are in the off weeks, right? So that we're not just totally taken aback, in that Wednesday meeting. I got a call from a TV reporter, and they asked me about, the new opening stuff. And I said, I've been looking all day. How did you find, the new opening? And he said, we just sit there and refresh the website. Like the governor doesn't even send out anything. They just refresh the website until the new information is there. Hi, Nico Ortiz. Long time no see.
Hi, Carol. How's it going?
Good. How are you doing?
Good. I'm trying to, this ERTC, I put in for the fourth quarter, but it's like, man, oh man, it's tough. It's not easy to figure out.
Yes, that's why we have Brad here.
And then the restaurant revitalization fund, they were going to require a DUNS number and go through sam.gov. I did that yesterday, just before they said that you didn't have to do it. I'm just like, I spent an hour doing that, and I'm like, great.
Well, it won't hurt you. Having a DUNS number actually, I think, does help your credit in some ways. So,
yeah, because I've had a DUNS number for years, but the sam.gov thing took me a while to figure out. Constantly changing targets, but hey, I'm amazed at the sheer number of restaurant people I talk to who are not going in for any of this stuff. And I'm like, the government's giving you money. When's the next time the government's ever going to give you money? Never, ever, until the next pandemic.
And I know a lot of folks feel like, I'll make it on my own. But you didn't close your own restaurant. They closed you. It's, I think you can feel good about going out and getting this money. I think it's there to get. I want to make sure, because the restaurant revitalization fund is going to go quickly. There's $28 billion for our industry. And so I want to make sure that our members get out there and get it. As soon as we get information on that, everybody, be looking for something to come out, because we'll do a webinar on it as soon as we get information on when that's the application is going to be out there. Okay, I'm going to start recording. And can you all see my screen? Yikes. I don't see my Zoom folks.
Yes, I can see your screen.
Thank
Yeah,
you.
We see you.
I can.
Okay.
I see Brett, Jerry, Nico.
How's that?
No.
New Mexico Restaurant Association?
Yep, we can see that now, Carol.
Yay.
Yep,
Okay.
yep, we got it.
I'm going to I'm going to go through a couple of screens here and then just keep going. So today's webinar is about the employment retention tax credit. This is one of the more tricky grants that you can get from the government, and that's why we're having this webinar. We're having it a little bit later than we did some of the other ones, just because some things changed. In the very beginning, you weren't able to go after this money if you got a PPP loan, but now you can. So anyway, and the other thing is that I had somebody tell me that they got $200,000 for their restaurant through this, and it doesn't go against your EIDL loan, it doesn't go against your PPP. So anyway, pay attention. So just some housekeeping. Everyone is going to be muted. Please use the chat box to ask any questions. All the questions will be held until the end of the presentation. This presentation is being recorded and it will be on our website and our YouTube site in 24 hours. And the slide deck will be available at the same time. So just let us know if you need anything more than that. You all know me. If you don't, I'm Carol White, the CEO of the New Mexico Restaurant Association. And I have two quick notes. One is I really need you all to get on your unemployment account online. That's your Workforce Solutions account, and make sure that you don't have any employees that are being charged against your account. We have many restaurateurs that have had their rate go from, say, 0.33, which is the lowest rate you can get, to 4.58. And you need to know this. Number one, the department was never supposed to charge those employees against your account, but they are, and they're making you go in and satisfy them that those people were laid off because of COVID. We're working with the department as well. We're trying to get them to do this as a blanket piece rather than making each employer go in individually. And it's happening more in restaurants than any other industry, obviously, because we had more layoffs, et cetera. So please go in, and if you have questions about it, you're always welcome to email me at executive@nmrestaurants.org. But it's really, really critical that you do this. I don't want you guys to be paying huge amounts of unemployment in the next year. So please go check that, number one. Number two, the Serving New Mexico Fund, we're about to get another $50,000 grant from Exxon Oil Company. And so we're going to have lots of money in that fund. Last year, we gave out $100,000 to employees in our industry that were having hardships. And I'm sure you all know some of those employees. I saw something in the Taos paper that there's a lot of employees, a lot of folks that are having a hard time paying their utility bills, things like that. And we really do want to help those folks that are in our industry. And really, the criteria is, did you work in the industry, and are you still out of work? And now that more people are coming back to work, we'll include those in that fund as well. So please let them know about the Serving New Mexico Fund. It's on our website under our Education Foundation. And with that, I would like to introduce you all to Brad Steward. Brad was with us early in the year when we were going through some of the PPP stuff. Brad is with PULANOS CPAs. He's a CPA and just somebody I can call on a regular basis for help, and he's been very helpful to a lot of our members. Welcome, Brad. Thanks for being here.
Oh, thank you, Carol. And thanks to everyone. And while I go through this presentation on the employee retention credit, I tend to be very factual. Realize I am very sensitive to the fact that a lot of people on this call have been impacted substantially, and it's emotional, and it's not your fault, and I understand. But I'm trying to just go through the factual content on this. I'm not trying to be insensitive. So, I am with PULANOS CPAs. I get the pleasure of leading 40 folks that serve clients that are primarily in New Mexico, but clients that operate all around the world. While we're 40 people here, we have a lot of resources to do some very, very complex tax and transactional type work for people that are either acquiring entities or selling them, including helping companies with international issues as they grow and expand. Now, that may not fit into the restaurant industry unless you're down along the border and thinking about doing something in Mexico, but certainly we have capability to serve about anybody that has an issue. We don't do work for public companies. We stay focused on companies that have private financing or bank financing and are trying to grow here in New Mexico or other places around the country. So with that, I'm here to talk to you today about the employee retention credit. And I think I have control. If we're, let's see, Carol, maybe oh, here we go. Just took a second. So first, I always have to put a disclaimer on these. And it's when Carol first asked me to do this, I said, Carol, we got out in front of this a year ago. We're giving presentations all the time. The problem was we had to keep updating all these all the time because of changes that were coming out. And I said, we kind of got a little bit in the butt on that. So we've held off a little bit this time, but I think we're in good shape to do something on the ERC now. And for instance, there was IRS guidance finally issued on March 1 of 2021 that actually covered how you handle employee retention credit activities for 2020. So the timing of when these things come out is very, very difficult, but all the information we have here today is relatively current, and I feel if you file for the credit using some of the information we're going to talk about here today, you'll be perfectly fine. I put together an agenda because people like to see an agenda, but we'll just jump right into the middle of it here. So first, let me tell you about the credit itself. It was available for 2020 and 2021. It's a refundable credit, meaning that if you file for it on the 941 and your liability on the 941, for example, is $40,000 and the credit you're asking for is $50,000, when the IRS actually handles your filing on the 941, you will see either a credit to your account or a check arrive for $10,000, meaning, again, it is refundable. So to the extent that it exceeds your liability on the 941, you're going to get a check back. So that's a good thing. The calculation for 2021 is very generous. It's calculated by quarter. It was modified in the most recent two pieces of legislation from the original CARES Act back in March of, it was passed, CARES Act was March 12th of 2020. The latest two rounds of legislation in December 28th, and then most recently on March 11th, modified it. It's a very lucrative credit for 2021. It is calculated by quarter. For 2020, it's calculated for the entire year. It's 50% of up to $10,000 of wages paid per employee during the period. That's the 2020 calculation. The 2021 is 70%, and it's calculated by quarter. The other part, which Carol mentioned, previously you had to elect whether you were going to do the PPP loan or whether you were going to do the employee retention credit. Now what happens is you can do both in the same year. You just can't do it on the same wages. So the calculation, I think somebody mentioned earlier, is a little more complex, but it's still very, very beneficial. And I would encourage everybody to look hard at this. The other part is you have to be an eligible employer. And there's two different types of eligible employers that I'll talk about here in a minute. But an eligible employer in general is a business that has been impacted by COVID-19. The original legislation didn't say negatively impacted, but that's the implication because there are certain declines you have to have either in revenue or you have to be negatively impacted as a result of restrictions that have been placed on all or part of your business by a governmental entity, like what we've seen here in New Mexico. So qualifying for the credit for 2020. And again, this is employers to be a qualified employer. You have to fit into one of the two categories. And the interesting part about this is the category does not lock you in for the entire year. So first category is a business that's fully or partially suspended by governmental order during a calendar quarter. And that's very important because if like what we experienced last year, we had a restriction starting to be placed on our businesses toward the middle to end of March last year, which is part of the first calendar quarter. So that means from every payroll paid after March 13th, which is the date after the legislation was passed, you can start taking the credit for eligible wages. Most of us had payroll toward the end of March. And usually one or two payrolls in April before we got the PPP loan, which starts the covered period, which those wages you can't apply for this credit on. So there's usually a couple of them right at the beginning that you can take into consideration for getting this credit. The other item that you can qualify with is your gross receipts have to have declined by 50% of the comparable quarter in 2019. So first quarter 2019 to first quarter 2020, you have a 50% decline in receipts, then you could qualify for that quarter. But you may have been able to qualify because of the fully or partially suspended by the government orders for the first quarter, and may apply for the second quarter in the same way. Third quarter, you may have been able to maybe partially open, but you still qualify in the first one. As we end the year, if you're able to open more, well, you can start to use both of these calculations to decide what's best for you. And the way they talk about fully or partially suspended is they talk about a nominal reduction in revenue. So if you have a 10% or more, if you have a partial suspension in revenue decline, you can qualify for that first piece. And so again, look at this, see which piece you fit into, and realize it's every calendar quarter. So if we start the quarter, which we're going to do tomorrow, with a quarter where we're under suspension. So if we start with April 1 and that suspension is still in place, then all wages paid from April 1 through June 30, we can qualify for that quarter for the 2021 credit. So realize that it's beneficial. In the second credit, which I talked about a little bit here, 2021, it's now been expanded to the entire year of 2021. Originally, it was only the first two quarters. The latest legislation made it available to us all the way through December 31, which can be beneficial. I suspect in New Mexico, because of the conservative nature we've had in the restrictions, that we'll probably see restrictions through July 4th holiday, probably depending on how Memorial Day goes. We could see restrictions into that first month of July. And so that's going to create some interesting things for people to be able to take that for that entire quarter. So keep that in mind. The other way you can qualify for this is if your gross receipts declined 20% to the comparable quarter in 2019. So either one works. You just have to document which one you're going to fit into. So that gets us to the next thing, documentation. There is really nothing you file associated with this credit other than you file the information on the 941. And it asks for the qualifying wages that apply and how much you're asking for in the credit. All the other documentation, your computation, the reason for meeting as a qualified employer, what criteria you're following, all that is your documentation. So I would keep all that stuff on file. You have a requirement to retain it for 4 years or whatever your document retention policy is, whichever is greater. So if you have a policy that you're keeping stuff for 6 years, which is not uncommon, keep it for 6. If you have a policy that says you're keeping records for 3, which can happen, in certain instances, maintain it for at least 4, because the law says you have to retain it for 4 years. I would keep copies of all of the governor's state of emergency orders, and they're actually all available still on the website. In addition to that, I'd copy and keep all of the New Mexico Secretary of Health orders, because again, they're all available to you on the website to document these restrictions, because 4 years from now, if somebody's looking at it, they won't remember when we came off and on restrictions or how those restrictions worked. So make sure you keep that. Document how the closure or limitation of your business has happened to make you an eligible employer. And then, as I mentioned, we just got guidance on March 1st of this year for 2020, last year. So keep whatever guidance you have, and whether it's this presentation with a date on it, whether it's IRS guidance that you can download from their website, that notice happens to be 2021-20 is the notice that's out there. Keep that in your files. And if you qualifying as a qualifying employer means a revenue reduction, make sure you keep those records to show that revenue reduction, because you want to keep all that documentation there as well as the computation of the credit itself. So here's an important part. For 2020, in order to be able to take this for all your employees in 2020, you have to have had, they call it 100 average employees or less in 2019. Average employees is not defined anywhere in the IRS, which is the one that governs this. They also don't really have too many definitions of something called a full-time equivalent, and I'll explain that here in a minute. So what the PPP loan did was say, we need you to compute full-time equivalents. So a full-time equivalent is if I had 2 people working 1,040 hours during the year, essentially I have 1 full-time equivalent, because combined they're 2,080 hours or 2,088 hours, depending on how you calculate a full year's worth of work. So that would equal 1 full-time employee for this computation. Now the PPP loan documentation said you can shortcut that computation, and you can say for everybody that's part-time, I can count them as a half. And for everybody that's salaried or full-time, I count them as a 1. And you add all those up, and if you're 100 or less in 2019, then you should be fine taking this credit as a small employer. If in doing that quick calculation, you're right on the edge or you're over, then I might go in and do a computation based on the hours an employee had divided by 2080 to come up with a portion of a year for that employee and add all those portions up. So in other words, if you had people who, I'm trying to think, had 600 or 700 hours, then that would be 1/3 of a year. So 3 of them would equal 1 average employee or 1 full-time employee. And this is important because if you're a small employer, you get to take this credit against all wages paid from March 13th, 2020 to December 31, 2020, that wasn't part of the PPP loan and wasn't part of the FFCRA, meaning if somebody had to take leave because they were out with COVID or caring for somebody with COVID and you got reimbursed from the federal government for those amounts, you can't double dip, but you can take it for all the employees. If you're over 100 employees, you can only take it in 2020 for those employees you were paying who were not working. So just keep that in mind. You're also able to add, if you're having a hard time getting to 10,000 and you pay a portion of the healthcare costs for the employee as the employer, then you can add that to the wages to get to that $10,000 number if you need to. And then of course, in this bullet, I did say, realize you can't double dip with the PPP loan forgiveness, and you can't double dip with FFCRA. And again, it's 50% of the first 10,000 for 2020. A 30 to 50 employee organization, we've seen credits on the order of $155,000 to $180,000. So just keep that in mind. The credits can really be beneficial. PPP loans were first. So when this whole thing came out, we told people, if you can qualify for the PPP loan, do the PPP loan. But now that we can do both, this is a beneficial credit you can collect. So let's talk about small employer for 2021. If you have 500 or less average employees, so same issue, you need to calculate essentially the full-time equivalents, then you are a qualified small employer, and you're a qualified employer, but now you're a small employer, and you can use this credit against all employee wages from January 1, 2021 to December 31, 2021. And again, it's any quarter that's impacted qualifies. And you have the same issue with the applicable portion of healthcare if you need it to get to the 10,000. Most people we've seen are able to get to the 10,000 without adding any cost of employer healthcare. It makes the computation easier. So we've recommended just do it based on wages if you can and get to the full amount. The credit in 2021 is much more lucrative, 70% up to the first 10,000 paid per employee during those applicable quarters. And we've seen those credits by quarter, because we're just ending a quarter now. Some of the initial calculations for a similar size, 30 to 50 kind of full-time equivalent employer, 180 to 280,000 during just the first quarter alone. And again, we haven't had any restrictions lifted so far for the next quarter. So the next quarter is going to be applicable in New Mexico for most employers. So how do you get the dollars? There used to be, and you may see some of this on the web, a Form 7200. I didn't even put it on the sheets because I didn't want people to start looking for it. But I will just tell you, if you Google this and find there's a Form 7200 you should be filing, forget that, it's gone. It's non-applicable anymore. So everything has to be filed on the quarterly Form 941, or for 2020, you're going to file 941Xs, which is an amended Form 941. Both of them are relatively easy to fill out. There's a line for the employee retention credit that requires you to put in the amount of the credit and the applicable wages. You'll see how that's done in there. There's actually two places it goes into. Don't worry about that. It's going to talk about refundable and non-refundable. The form is confusing. Just understand the whole thing's refundable. The original legislation had some pieces in there that said a portion of it's going to get allocated to the old age security. It's basically Social Security. It's the old age fund, which was the original term for that. So a portion of it gets allocated to Social Security amounts, and then another portion gets out of withholdings. Again, don't worry about it as long as you get it allocated right, which is pretty easy based on the way the form's set up. But the bad part is for 2020 now, you have to file an amended 941X. And as near as we can find out, you have to file that in paper form, which means getting the amount for 2020 may take a little bit longer. For this first quarter, you'll be able to take it against the March 941, which you're going to file before the end of April. So there's some time here. So general recommendations, I would say use this credit. Retain the documentation. There's nothing you have to file with the 940X or the 941, I'm sorry, the 941X or the 941 if you regularly file like for this first quarter. Again, you just have to keep all that information. And the likelihood that you're going to be asked for this information is probably low, but make sure you have it all. So that way, if you do get asked, you can readily show it to whoever asks you for it, which is going to be the IRS asking the question. And so that's, I think, about 20 minutes of time, and I am available to go through any questions you guys have, because I know this can be a difficult subject in doing the computations. We've done quite a few of them, but I'm happy to answer any questions people have.
Thanks so much. We do have some questions, and I'm going to let Dion, if you will, kind of collate those and ask those questions. And I'm sure we're going to have more. And, you know, the reason we haven't done this before is because it did seem very complicated. Mm-hmm. So would you suggest that if they have a CPA, they use their CPA, obviously, right?
Well, yeah, I would suggest you use your CPA. Even if you just have your CPA review your computation. And I will tell you the easiest way to do this, if people have Excel, is to just take all the employees you paid throughout the year and put them in a column on the left side, and then take the payroll by payroll date and put in how much you paid them each payroll period. And make sure you don't take payroll periods that you that were part of your covered period computation for forgiveness on the PPP loan, but all the other ones work. And basically you go through the process of totaling it up until you hit 10,000 in wages per employee. It doesn't have to be employees that were all there on January 1 of 2020. In other words, if you had people leave, you can take it for that portion of computation, that portion of payroll until they left. And then if you hired somebody to replace them, then you pick up with that portion of payroll. So it's basically a computation sheet, and it just takes a while to get through it.
So we got some questions, and I don't know if Dion is here. So
I'm here. I was just waiting
to
see if you guys needed anything. So we do have a question from Nico. Since the ERTC is claimed on our 941 form, do we use 941 wages, which include tips, or just the wages that were actually paid by the restaurants? Tips are a significant part of my 941 reported income for taxes.
You know, it's an interesting comment. I think the way the IRS treats the tips is that the organization is actually paying them to the employees, don't they? I'm looking to Carol right now, but I'm pretty sure that's the way it's treated. It's not treated as an agency relationship because you're withholding taxes on those, right?
Somebody else answer that. Yes,
well,
we do.
Yeah, Nico's point was that he's getting a tax benefit on compensation that wasn't actually paid by him.
Well, yeah, but I think it is considered paid by him. Because you're withholding taxes on those numbers, I think you're considered to be that pass-through organization. So I think you can take it on the entire amount that flows through your organization into their payroll.
Because I did pull the actual instructions for the Form 7200, didn't use it, but in the instructions for the Form 7200, it did say qualified wages, including qualified health plan expenses. Well, it says qualified wages or wages for Social Security and Medicare tax purposes paid to certain employees, blah, blah, blah.
Yeah, if it shows up in box 2, and in fact, 2 or 3 on the W-2, that's qualified wages, and I think you include that in there.
Yeah, because obviously there's a ginormous difference in the tax credit if I include tips than if I do not include tips. But I was just, I filed the 941X conservative side in 2020, not including tips, just because I didn't want the government to come back and say I owed them $75,000. But in 2021, if I can include the tips, I mean, that's our employees probably make $400,000 a year in tips. you know,
Wow.
and that's $40,000 is huge.
Yeah, let me double check that, but I'm almost positive it's everything that shows up in box 3 for Social Security wages.
Yeah,
that's
because
qualifying.
wages include all tips. So, okay.
Yeah.
So talking about new businesses, Roman asks, how does the quarter comparison apply to new businesses who are not open in some of 2019?
Yeah, so so for those quarters where you weren't open in 2019, there is a separate calculation methodology depending on when you were open. And I don't know how many people on here were open and new businesses in 2019, but I'm going to tell you, I'm going to refer you to that IRS notice I mentioned. You can Google it. It's notice 2021-20. There are some very specific calculation methodologies, and they give you options. And basically what they say is you can start to use quarter to quarter analysis if that helps you. And then the other thing I would tell you is probably just the fact we were under government orders for most of 2020 is the place I would go to qualify for the credit as opposed to the revenue reduction. I think you have a very strong leg to stand on as the restaurant industry because of the restrictions that everybody's been under. So if you're a new business, I would use that. Even an existing business, I probably would use that.
And would you use the owner's salary too for the credit?
So this is interesting. If you're organized as an S corp or organized as a C corp or organized as an LLC taxed as an S corp, then the owner is considered an employee, and you can usually take those wages because it's again going to show up on a W-2. If it's not W-2 wages, it is less likely you're going to be able to do that.
Great. Now, if they use the PPP for our PR, we are not able to apply for the employee tax credit.
I'm sorry, state that other acronym you used.
Janine might need to jump in, but she
Payroll.
said if we use the PPP for our PR, we are not able to apply for the employee tax credit.
Oh, for payroll, meaning PR. Okay, got
Payroll, yes.
Yeah,
I'm sorry.
yeah,
I didn't know
got
what
it,
she was
got it.
saying.
it. Yeah,
Yes.
It took me a second because I was
Sorry.
thinking, what was it? What did they use it for? No. So you could use the PPP loan to pay for payroll and healthcare and other costs, right? Employer provided healthcare. The key on the employee retention credit is to the extent during your covered period, which is the date you funded, the date was funded under your PPP loan, then for an 8-week period after that, those qualifying wages, or if you use the 24-week period, those qualifying wages that allowed you to get forgiveness, you can't use those to calculate the employee retention credit, but all other wages you can. So most people didn't get the PPP loan until at least the middle of April. Sometimes it was into May when they got the PPP loan in 2020. And because this allows you under the employee retention credit to start taking it on wages the day after the law was passed, which is March 13th. So any wages you paid from March 13th until you got funded on your PPP loan can qualify for the employee retention credit. And then once you get to the end of that covered period, then those wages from that point through the end of the year can also qualify for the employee retention credit. So you can take it, you just can't take it on the same wages, but you can take the employee retention credit in 2020, even if you had a PPP loan. Originally, the legislation said you had to pick one or the other. Now they're allowing us to take it on those wages we didn't qualify under PPP loan forgiveness.
So, hi, this is Janine. So in other words, say we use the PPP, like you say, from March 3rd, I mean, we don't use it from March 13th. So when we received it, that qualifies. And then when we run out till, say, if we got the second go around, in between there, those wages will qualify?
Yes. So if you did the first draw, let me use an example. So you start March 13th. If you had a payroll on March 15th, then those are qualifying wages assuming you were under restrictions, which we were here in New Mexico. So that March 15th payroll, then there's a payroll, let's say March 31st. So that payroll qualifies. You have another payroll on April 15th, that qualifies for the employee retention credit. And let's say you had another payroll on April 13th, and then you were funded, or I'm sorry, April 30th, and then you were funded on your PPP loan on May 5th. So payroll paid from May 5th until you get to your forgiveness amount, either the 8-week period or a portion of the 24-week period, those wages you can't take the employee retention credit against. And whenever you hit the end of that 24-week period, so let's say you had to use the full 24-week period to get there. So we'd be, let's see, probably be out into October. So then October, because you've now met all your requirements for forgiveness, then wages that you start to pay around October 15th, October 31st, November 15th, November 30th, December 15th, December 31 in my example, all those wages can qualify for the employee retention credit.
Oh, okay. Thank you.
Sure.
And honestly, again, I know how confusing this is, and we do have a question in here, Brad, that one of our members, her bookkeeper won't do this for her. And can your company help folks with this?
Yeah, we certainly can. We've done quite a few of these for companies that we do both the managed accounting services for, bookkeeping and other services that we do. And we've also helped other clients tax and audit as well to qualify for this. And yeah, so we can certainly help you. It takes, we need your payroll registers for those pay periods that are outside the scope of your PPP loan covered period. And we can input the data and do it. And there's a fee for doing it, but it's well worthwhile.
Well,
Brad,
when we
we-
talk about the number you're talking about, it's true. It is well worthwhile. Go ahead, Dion, sorry.
Oh, that's okay. Brad, we had one question about if we could look at an example or certain scenario. Can you run perhaps through a scenario where an employee made, say, $5,000 in Q3 of 2020, and then the same employee made $7,000 in Q4 of 2020?
So they made 5,000 in one quarter, 7,000
And 7,000 in Q4.
in Q4. So what happens is for the third quarter, if you just had that one employee, so you'd get 2,500 in credit for the third quarter, and you'd file a 940X. This is a quarter of 2020. You'd file a 940X for the third quarter of 2020. Okay, it's an amended 941. You're going to show 5,000 in qualifying wages, and you're going to show 2,500 of credit. And then in the fourth quarter, you're going to show $5,000 of qualifying wages and $2,500 of credit again, because the maximum you can take it on is 10,000 of wages. So in your example, somebody made $12,000 between those two. So the max you can do is $10,000 per person times 50% for 2020. The 2020 calculation is a little more involved because you have to keep a running total of what you've taken in wages per employee, whereas the calculation in 2021 is much easier because it's only calculated on a quarter by quarter basis. In effect, it resets every quarter.
And another tipped question, do we remove tip wages that have qualified for the FICA tip credit on Form 8846?
That one I'm not sure of, and I'll have to find out. Basically, if it's included in FICA, if you're paying the employer portion of FICA, the 6.2% on those wages, the definition of qualifying wages is those FICA wages. So if you're paying the 6.2% as an employer on, in this example, the 5,000 and the 7,000, if you're paying 6.2% on that, then that's qualifying wages.
And
If
it
you're
looks like,
getting a credit back for it, it probably doesn't qualify.
and I think we covered this, but just if we could restate or reword it, can we take all of the wages paid in 2020 to an employee regardless of whether they are full or part-time?
Yes. Yes, if it shows up as wages that you're paying that 6.2% on, those are qualifying wages for this calculation. That's why as an employee, if you're the owner and you're an owner employee in a C Corp or a S Corp or an LLC taxed as an S Corp, you're going to have your wages are going to show up as wages you're paying the 6.2% on. And that's the basis for making it a qualifying wage.
Another clarification, for 2021, how much of a reduction in gross receipts must you have to be eligible?
So in 2021, the calculation is 20, I'm just going to go back to make sure I don't mess this up because we've had so many different percentages. I believe it's 20%. Yes, 20% decline. So you take the comparable quarter in 2019 compared to the comparable quarter in 2021. And if you've had a 20% decline, then you qualify. But again, if it were me, I mean, given the industry you're in and the government restrictions on your industry, I think you can clearly show that you've had restrictions on a substantial portion of your business.
Great. And our last request is for contact information. So I will make sure that we include that in the chat box as well.
Oh, thanks. Thanks.
And just a reminder, you can also find him on our membership directory, which is on our website. Carol, that's it for questions. If you guys want to wrap anything else up.
I'm gonna just show folks how to get to some of this. So our online directory you can get to here, and Brad is a member, and so you can get to his business here. And some of those the PHOs and things that Brad was talking about are here on this site. The reopening map, here it is. The newest PHO here, the newest PHO here. So most of the PHOs, that's the public health orders, are here. And what he's saying is you collect all of that information, print it out, put it in a file, and that's your proof that yes, you were closed down during those times.
Yeah.
And we have had some kind of restriction through the entire year. And again,
they haven't been nominal, they haven't been inconsequential restrictions. So that's where I'm saying I think under the IRS rules, restaurants are an easy one to qualify.
more questions?
No more questions. Just a reminder that we do have the whole entire history of the pandemic on here as well. So if they need to go back to certain dates on when certain restrictions were occurring, they can find that as well.
Very cool.
Yeah, unfortunately, that's what
I mean, yeah, sorry, I'm not trying to be insensitive. I have sat across the table from individuals who have worked 25, 30 years to build up a business to have it go to zero in a matter of months. And they're just in tears. And I'm not trying to be insensitive. It's not an easy time.
Well, and I did want to show folks that we do have good resources on our website. You can call us. We also have on our website, you can chat with us. We have a help desk. And so don't hesitate to do that. You're usually going to get one of our folks who can answer most of your questions. We're not CPAs, we're not lawyers. And I will say, this is an overview. We're not CPA. I'm not a CPA. I'm not a lawyer. And please, use those folks that you have to help you do some of this. But when I heard that people were getting, upwards of $100,000 back for this tax credit, I had to make sure and get this information out to you. And no matter how difficult it is, if you even spend 2 days on it, that's 2 days that are well worth that kind of money. And I know it's hard. And I had a restaurateur share with me the other day, and I think she's on the phone or on the call here. She shared with me that she is spending most of her time getting grants and these other things that are available to her, and it's a lot of work, and it's not work that restaurateurs usually do. But I would just encourage you, use PULANOS. They've been kind enough to do this for us for free, and if you are having a hard time and don't mind paying them, and that's one thing I told Brad when I first told him this. I said, I think people will pay you. It's a matter of, we need to help them as much as we can. So
Yeah.
There-
No, it's the computation. 2020 is a more difficult computation. I'll just tell you up front again, because you have to track stuff by employee, by pay period, until you hit the 10,000, and that can be that can be a little trying. 2021 is much easier, but like you said, Carol, if you can get $100,000, it is taxable. So, just realize that it will be included in your taxable income, unlike the PPP forgiveness numbers or amounts. But still, it's beneficial numbers. And if you took the 100,000 and you used them, Carol, you and I were talking earlier, to have them as sign-on bonuses for people to try and get people to come back to work. There's things you could use it for. Obviously, those are deductions against the money you get. So it's spending it in a way that's important. And if you spent the whole thing that way, then none of it's taxable, right? I mean, you're going to end up paying a little bit on the 6.2% that you're going to have to remit as an employer, but still, it's a good sum of money. And the numbers we're seeing are pretty substantial. They're not as great as PPP. Again, if you can do PPP, do that all day long. But now you can get it for the other wages on the either end of that covered period for the PPP loan forgiveness activities. There's actually depending on how you filed your PPP loan forgiveness, I'll throw this out. It's makes it a little more complex, but depending on how you did your PPP loan forgiveness, if you included $200,000 of wages, and your PPP loan was 180,000. Now let me use a different one. You included 250,000, and your PPP loan was 180, and you needed 200,000 because you had some FTE reductions or something else that caused that 200,000 to go down and be able to cover the 180. You didn't need the 250. Then this is where the computation gets a little more complex, because if we're short trying to get the maximum amount of the ERC, then the computation says you can take that excess above the 200,000 and include it for ERC. So just realize that it's not the entire amount of that covered period. If we're short, we need to go back and look and see if the way you did your computation for the PPP loan forgiveness, there may be some excess wages in there that we could also use to get part of the ERC forgiveness. So that's why sometimes it can get a little more complex, and probably why you see a lot of people that don't want to do the computation, truthfully.
Yeah. Well, and especially if you're doing it on your own. Dion, did you say we have two more questions?
Yes, we had 2 more questions from our Facebook audience, and I just want to remind folks on Facebook and the meeting that if there's something that we missed or you came in late, this will be offered on a recording on our website as well. But real quick, Brad, I'm sorry.
That's okay.
They just want to clarify whether you mean gross wages and not net wages paid when you're calculating the employee's wages.
So the easy way to think about it, and I'm not sure what I assume what they mean by net is the amount after you've acted as a trustee for the employee's taxes that you're remitting. So the key here is it's not net. It is the wages that you're as an employer that are used to calculate your liability for the matching component of the Social Security. So it's effectively the wages that you're paying that 6.2% against. And maybe even a better way to put it is, because if you have employees that make more, they actually tap out in the 6.2%, it'd be anything that you're paying the Medicare component, which is the other 1.35. So however you want to look at it, it is the amount that you as an employer are paying either the Social Security or the Medicare taxes that have to be remitted as your responsibility for having an employee, the matching component. Does that make sense? So it's really not net after you're acting, because you're acting as a trustee, right? If the employee fills out a W-4, which they do, I shouldn't say if, they fill out a W-4 and tell you how many deductions and how much they want taken out of their paycheck. That's how you get to the net amount. Well, that net amount is all you're doing is acting as a trustee to remit that to the federal government or the state authorities. So it's that gross amount before you're acting as a trustee that's the important part of these wage components. Okay, and that's the part you get to take the credit against.
Right. And our final question is just to clarify that one can only apply if any of the same quarter gross receipts are down 50% between 2019 and 2020.
Now there's two components to this. So it's an or category. So it's not and, it's or. So if you're under a government restriction and it causes a negative impact on your business, and they've determined that nominal component to be about a 10% decline for the year. So take CPAs, for example, okay? We are under a restriction today that if you read the order, it says we're only allowed to do and receive compensation for services that are legally required, okay? That means I can't do estate planning, I can't do business consulting, I can't do a host of things that I would normally do. It means I can file tax returns, which is really not the important thing we do. The important thing we do is help people pay what they owe. And then we do a lot of consulting to make sure they do that over their lifetime, the least amount they have to pay over their lifetime, right? And so there's estate planning that goes along with that. There's business consulting that helps them put more money in their pocket. Those are much larger components of what we do. So we've been under some restrictions that are causing reductions in our revenue. So that first piece, if you're under an order that's causing restrictions on how you do business during 2019 or 2020, and even into 2021, you qualify for the credit. If for some reason you're not under restrictions, but just general behavioral changes are causing a big reduction in your revenue. So if you were in Florida, which has had very few reductions, but because of all the news media and everything, people are not going out until they get vaccinated. I'm not saying that's the case, but let's say it is, that people have just changed their behaviors. They're not leaving the house. I know some people like that. Early on, they were, taking their newspaper and putting it out and spraying it with chlorine and letting it dry the next day. I mean, there was a lot of things happening at the beginning of this. So let's say you're in Florida, no government restrictions, but you had that revenue reduction that caused you to meet it. Well, then they can qualify. But in New Mexico, because we're under these restrictions, I don't know that many of you are going to have to do that computation on revenue. You qualify, in other words.
So Brad, somebody mentioned, and I just want to say, they mentioned a policy briefing from the National Restaurant Association about this, and it says it does indicate that tips are not considered eligible wages. Here's what I'm going to do. I'm going to clarify that. I will send that policy brief out in our next email, and Lawrence, keep me to this. But we'll send that out. And basically what I'll do is I'll send it with this recording so that you'll have it as well.
What date was that? Just out of curiosity, Carol.
He said it references IRS section 3231E and indicates that tips are not considered eligible wages. So we'll make sure we'll send that out to you. I don't want you making big mistakes on this, but
yeah, And I'll double check it too. The guidance I have says that if you pay the Social Security tax or Medicare tax on the wages, it's qualifying wages.
Yeah, the policy brief was February 22nd, 2021. The NRA, yeah, it's called understanding. I just printed out in the IRS code 3231E. It does say the compensation does not include tips, but it says except as provided under paragraph 3, which I have not looked at paragraph 3, but it clearly says compensation does not include tips in this IRS 3231E.
Okay.
So,
So the,
I mean,
the publication that came out in March basically said qualifying wages are those wages you pay the Social Security tax on as an
Yeah.
employer. So
so frustrating.
we'll find out. We'll find
So
out.
we'll find out, and I will get that out to everybody. And I'm assuming everybody here is on our email list. If you're not, subscribe on our website, and you'll get that information.
Yeah, we'll double check it and make sure so nobody does it wrong.
Yeah.
Yeah.
All right. I think that's it. Brad, thank you so much for being here. Thank you all for participating as well. I really want you to get as much money as you can, as much of the money that the government basically, they shut us down. Don't be shy about going after it. So thank you all. Thanks, Brad. Take care.
Thank you guys. Take care. Have a good Easter.